Module 3, Types of Venture Instruments. Unit 1, Convertible Debt. With a convertible debt structure, the stock price is not set and is determined at a later date when a larger financing occurs. In simple terms, if there's a later round, the company indeed must have done things to attract investors. Having a discount is nice, but the ultimate price for the early convertible debt investors may still be higher than what they would have incurred, particularly if they had put equity in the initial round. In some cases, investors try to sort this issue by agreeing to a valuation cap. The second is the discount. Typically, in a convertible debt, the discount to the price of the stock ranges between 10 to 30%. However, 20% is more common. Sometimes you would also see a discount that increases over time. For instance, a 10 to 15% discount if the round closes in 90 days, then a 20 to 25% discount if it takes more time or more than that. A valuation cap. In most cases, entrepreneurs may not prefer to have a valuation cap, but investors would prefer to have this. Interest rates. In most cases, an interest rate is the minimum upside that a convertible debt investor would take. In dollar terms, it's most common to see an 8% interest rate on average, where the discount is between 10 to 30%. Conversion mechanics. Usually, the convertible debt would eventually hopefully convert to equity. The term of the convertible debt typically needs to be determined. Most VCs have a mandate to negotiate up to a 12-month or a 1-year tenor by their LPs. Usually, the amount needed to raise is determined by the minimum amount of equity required for the raise by the entrepreneur. Conversion in the sale of a company. Usually, conversion also can happen when a company is being sold as a secondary sale to another company that takes over the operations. The lender typically gets her money back plus the interest plus a multiple of the original principal amount. The bad news is if the merger is an all-stock deal, meaning there's no cash, the company will need to find a way to get cash to pay back the loan or negotiate a way for the acquiring company to deal with the debts that was issued before. Unit 2, the capitalization table. The cap table summarizes who owns what part of the company before and after different financing rounds. There are various ways of presenting a cap table. For example, the pre-money method. The second is the percentage ownership method. And the third is a dollars invested method. As an entrepreneur, it is important for you to have a clear capitalization table breaking down the ownership structure and the incentives for each investor in your company to ensure that there is clarity of the ownership and process. Unit 3, crowdfunding. There are different types of crowdfunding mechanisms. The first one is a product crowdfunding. In this case, the product is typically in an early design stage and far from ready to ship, assuming it's a physical product or a software far away from the launch. The rewards vary by dollar amounts. The rewards for the product crowdfunders may vary by dollar amount, or in other cases, the crowdfunders would receive, say, logoed stickers, t-shirts, sponsorship recognition, or real world events to celebrate the product launch. Product crowdfunding may also come as a pre-order financing, where the crowd is financing a pre-order of the products. The funding is typically equity-free. Equity and debt crowdfunding. These are other ways of crowdfunding. In an equity and debt crowdfunding, the investor gives money in exchange for a security, such as shareholding in the company or debt proceeds. One of the most popular crowdfunding platforms is AngelList. Most developed jurisdictions allow only accredited investors to participate in a crowdfunding round. An accredited investor is a person with substantial net worth or income. Most regulators also provide guidance on the solicitation process for funds from the public. Unit 4, venture debt. Venture debt is the debt financing to startups by banks or venture debt funds. It's more common in the US than in Africa. In order to lend to a startup, a bank would have to understand the primary source of repayment, or the PSOR, for a loan. Most loans to companies are term loans based on the cash flows of the company and the PSOR. The other type of debt are revolving lines of credit, which are advances based on the company's borrowing base, which acts as the collateral. For instance, accounts receivables or your debtor's value or inventory value in your balance sheet can act as collateral until when the debt investor converts to cash. For instance, account receivables or inventory value in the balance sheet can act as collateral until when these convert to cash. Most debt is in the form of growth capital of say over 4 years, but with a 6 to 12 month moratorium or payment holiday on principal, meaning you only pay interest during this moratorium period. Another type of loan or venture debt is recurring revenue loans, which are given to advanced companies providing standardized products such as software or media subscription type business models. This is advanced as long as there is a recurring billing and consistent pricing. When it comes to economic considerations, other than the interest rates and loan fees or for the loan, one needs to consider warrants. Some lenders may place warrants as another downside protection measure. For instance, a term sheet of $3 million may come with a warrant of 2% coverage, which translates to $60,000. Obviously, the best position for an entrepreneur is to negotiate a no-warrant loan that is non-dilutive in nature. There are also some banks which may impose prepayment penalties on early payment of principal over and above the contractual payment schedule. Unit 5. How VC funds work. So you may ask yourself, where do VCs actually get their money from? That is the money they invest to startups. VCs may raise money from a variety of entities, including government agencies, corporate pension funds, large corporations, banks, hedge funds, corporate foundations, professional institutional capital, high net worth individuals, family offices, funds of funds, endowments, private foundations, charitable trusts, insurance companies, among others. The contractual arrangement between the VCs and the investors, in this case investors are called limited partners or LPs, is a contract called the Limited Partnership Agreement. An example, if a VC raises, say $200 million fund, the venture capital firm typically keeps very little cash on hand and must ask its LPs every time it wants to deploy capital in an investment. This is known as a capital call, and it takes usually about 2 to 3 weeks from the moment the money is requested until it arrives. The LPs are legally obligated under the fund agreement to send the VCs money every time they make a capital call. It is also possible that a new LP buys the interests of an old LP in a VC fund as part of a secondary market sale. The other aspect of VC funds is management fees. Typically, VCs earn a management fee, which is a percentage of the amount of cash committed into a fund, or also known as assets under management for the fund. The fee normally ranges 1.5 to 2.5% and are normally paid out quarterly or semi-annually to finance the VC's operations. This may include staff salaries, travel, and other operational expenses. In most cases, a VC would commit to a commitment period during the fund's life when the capital has to be deployed. For instance, the first 5 years of a 10-year fund may be the deployment phase. In such instances, the commitment fee may reduce after the commitment phase. A GP or general partner may also be expected by the LPs to commit their own capital into the fund. This would be anywhere between 1 to 5% of the fund size. So in a $100 million fund size scenario, This would be $1 to $5 million. This is done normally to enhance alignment of incentives between the two parties. Another common term in a VC fund is carried interest. Carried interest, or carry, is a profit that VCs get after returning money to their investors or the LPs. For instance, in a $100 million fund scenario, VCs would receive the carry after they've returned $100 million or the full fund to their LPs. Most VCs get 20% of the profits after returning capital, or a 20% carry. However, there are instances where clawback positions or provisions may be triggered for carry that's already earned and losses incurred later in the fund life. Reimbursements. VCs receive a small income in the form of reimbursements from the companies they invest in for expenses associated with board meetings. VCs will charge a reasonable expense associated with board meetings to the companies they are investing or visiting. Reserves. Reserves are the amount of invested capital or investment capital that is allocated to each company that a VC invests in. This is a theoretical future amount for the fund to invest in follow-on rounds. Usually, the earlier the stage, the more reserve allocation would be for a particular entity. Most VC funds will allow a firm to raise a new fund once they deploy their first round. Some VC funds invest out of several linked fund entities. This scenario is also known as cross-fund investing. For instance, a VC can invest $100 million split into, say, $60 million and $40 million from two funds. The side fund usually has different economic arrangements than the main fund, and in this case, you may see various signature blocks from different entities linked to the VC. Departing partners. In most VC firms, they have a keyman clause that defines what happens in the case in which a certain number of partners or a specific partner leaves the firm. In some cases, when a firm trips the keyman or the key person clause, the LPs will have the right to suspend the ability of the fund to make new investments or can even shut down the fund. When a VC staff leaves a firm and leaves the board of a portfolio company, it can also mean different things for the invested company. It means the VC would have to replace the VC staff who was in the board with a new nominee from the VC.